All right, let's stick with the banks here. Morgan Stanley is reportedly looking at another round of job cuts, and this coming amid a slump in deal making as recession concerns linger. Here now to expand on the state of the banking sector and investor positioning, we've got David Ellison, Hennessy Large Cap Financial Fund Portfolio Manager. And David, as we talk about now the seizure of FRC and what's been happening in the banking system, there seems to be more discussion now about just how the broader economy is doing and banks effectively becoming less profitable as a result of all of this, hence something like the Morgan Stanley cuts. What's your thinking at this stage in the crisis?
Well, I think, I guess I've been saying that I think we need to sort of look forward and say, okay, well, rates have gone up, the yield curve is upside down, so that's hurting profitability. We've had that before. I think the credit cycle will kick in eventually at some point, probably this year, maybe early next year. And we're already seeing it a little bit in some of the smaller banks where they're having trouble with some of their loans. And that will weigh on profitability. I think the new thing that really stay focused on is what's happening with the flow of deposits and how quickly they're moving around the system, and whether it be digitization of the banking system or the shadow banks or all these other words that people use. At the end of the day, people can get to their money via their phone as opposed to having to go into the branch. That's becoming more ubiquitous. And as I say, we've had a lot of mark to market here with rates and prices of bonds going down. We've also had a lot of mark to market on social media. And that's sort of the new thing that I think we have to understand and corral. And I don't think the regulators really know what to do there in terms of trying to keep the flow of money from being so rapid and so quick like we've seen at some of these banks.
In terms of the financial conditions right now that we're seeing, David, does anything about the current financial conditions spell out to you Q3 2023 recession like we'd heard from some of the banks over the course of the earnings season thus far?
Well, I don't think, just because we may have a mild or noticeable credit cycle doesn't mean it's a recession. I think, we've had rates go up, so loans have been marked down. That doesn't mean it's a recession. So I think people are trying to say, well, there's going to be a recession, therefore there's going to be all these other things. We've had, 4 pretty significant bank failures in the face of record low unemployment and a reasonably good growth in GDP. And so I think we're kind of we're trying to say, well, there's going to be a recession, therefore all of these things are going to happen. I think all of those things that are going to happen could happen without a recession. And I think you see that this year where, tech is doing really well and the banks are doing really awful. And those 2 things can exist in the same universe, which probably never would have happened, 20 or 30 years ago.
Yeah, I mean, as you focus on banks in particular, David, I was intrigued in your notes that you are still looking at what you call the so-called broken names, or you say you're not shying away from them. And we're talking about the other regional banks that sort of got swept up in at least the stock action around all of this: Western Alliance, PacWest, Schwab. Why not shy away from them? Why not be more cautious on them?
Well, I think the hope here is that things will calm down and these companies can get refooted, so to speak, and the stocks will reflect that, in their valuations. And I think the struggle here is that that's taking a lot longer and it may not happen at all. So I think it's, but then the opportunity is pretty large on the upside. So, the problem in banking is that for example, in biotech, you can own 10 names. One name turns into a major company and the other 9 go bankrupt, you still outperform. You don't, because that other company goes up, 100-fold. And in the case of banking, I'm not going to buy a bank today that's going to go up 10-fold, meaning the stock price. And, so you've got to take some chances on companies that while the stocks look broken, the companies are working really hard to get back on sides and there's opportunity there. So that hasn't particularly worked. It worked a little bit in the last couple of weeks, but net it really has not worked, primarily because I'm coming back to this notion that we have to get our arms around what this deposit run really is. Is it a traditional deposit run, or is it something that's going to be more ubiquitous in the system, where it's going to happen more and more and unexpectedly because people can move their money so rapidly? So as a bank analyst for 40 years, I don't think of deposits as being a problem. Deposits were always the bedrock of the company. Now they're not, and I think we have to reassess what we own and what we take risks on because of that. And I think the Feds are trying to figure it out, the market's trying to figure it out, and so far everybody's generally been wrong, which is, in a sense, manifests itself in these bank failures of late.
David, I want to come back to something that you mentioned a moment ago in the kind of comparison or contrast of banks or the financials versus tech right now. And tech, largely this year, we've seen that up off of rebound from 2022 and even relief on beating some already lowered expectations. So what from your purview is the status of the health for the tech sector?
Well, I think that, I'm not a super big tech investor, but I think generally what I'm really trying to say there is that, we've been going into a recession for a year now, maybe 2 years now, and yet, there are certain parts of the market that are very strong. This bank thing that we've had here is really a function of advancing technology in the industry, and tech continues to evolve and change the economy. And so we're looking to the banks to say, well, the banks are in trouble, therefore there's going to be a recession. The reality is, I don't think that's the case. The banks are being, in a sense, blockbustered away through technology, and the tech companies continue to take share, and it's reflected in the market in terms of the earnings and the prices of the stock. So I think that's sort of the way I look at it. And I think that's a broader issue, but I'm not, I think tech continues to transform the world, and the banks have finally the technology issues have finally come home to roost with them. And I think the regulators are certainly behind the curve in terms of trying to figure out what they're going to do and how they're going to, and we'll see what happens, but they got a lot of work to do.
Yeah, most definitely. And if you look at what's happening with some of the fintechs, that's probably evident as well. David, good to catch up with you. Great to get your perspective on this. Obviously, as you mentioned, you've got a long history covering the banks. Hennessy Large Cap Financial Fund Portfolio Manager David Ellison.